And this is Bloomberg Technology. Coming up in the next hour, the Nasdaq posts its worst day since 2011 and lapses into correction. The S&P 500 and the Dow wipe out their gains for the year, and tech leads the way down. Plus, truly historic. That is how Elon Musk is describing Tesla's third quarter as the company reports its first profit in 5 years. Can they do it again and again? The data industrial complex. Apple CEO Tim Cook goes after his data-driven rivals. Why he says the way companies like Facebook do business should make you uncomfortable. But first to our top story, Tesla shares soaring in late trading as the company reports its third quarter earnings. Tesla usually gives about 2 weeks notice of when earnings will drop, but this time the company gave barely 2 days. And as Elon Musk strongly hinted, Tesla has made money. The company's net income was $312 million when analysts expected a loss. And get this, positive cash flow, $881 million. The earnings come on a day when the Nasdaq plunged, yet Tesla managed the 12th best performance in the Nasdaq 100. Joining us now, Kelly Blue Book executive analyst Akshay Anand, also with us, Bloomberg's Dana Hull, who of course covers Tesla. So Dana, walk us through the numbers.
Well, I think the big thing is that obviously they're profitable, huge. First time they've been profitable since the third quarter of 2016. So it's only their third profitable quarter ever in the company's long history, but demand is still really strong. I mean, that was the big surprise. The big bear thesis was that they pulled out all the stops in Q3 and that there would be no longer any demand for these cars. But the customer deposit number is still like $900
million in deposits.
Yeah. So demand for these cars is continuing, even though they have worked through some of the reservations. As more cars get on the road, more people are ordering them.
So Akshay, the question is, can they do this again and again and again? Is this going to become routine?
Yeah, I mean, this is, I think, what we're watching for, right? To Dana's point, there was a lot of speculation that some of these numbers might be front-loaded. But, I mean, this was a huge beat, as we all saw. And, Elon said as much that we expect to be profitable going forward from Q3 onwards. So if they can repeat this going forward, this is a huge win for Tesla, and it really shows the power of the brand more than anything.
I want to talk a little bit about the timing, Dana, because normally Tesla gives, a significant amount of notice for earnings results. This happened in less than 2 days on Monday night. We found out that Tesla would be reporting today. The SEC prefers to have more notice. Is there anything unusual about that?
Yeah,
anything
to be fair, Tesla always reports earnings on a Wednesday. Next Wednesday is Halloween. I know that myself and I think some analysts in New York were asking the company, can you please not do it on Halloween? Some of us have kids. So we were actually expecting that earnings would come maybe next Tuesday or possibly be pushed into November. But clearly the company has a good story to tell. Might as well tell it early. The fact that they pulled the earnings forward, everyone was expecting that this would be good news.
Akshay, let's take a deeper dive into the actual numbers. The company said still on target to deliver 100,000 Model S and X cars this year. Of course, we're always looking at the Model 3. When you look at the actual delivery numbers, are you liking what you see?
Yeah, I mean, I think one of the big things about the delivery numbers is Model 3, Model S, Model X were all strong. And keep in mind, we haven't even seen the base level Model 3 yet, right? So I think that's a key part of what we're looking at is going forward. Once the base level Model 3 does come out, a lot of consumers are going to want this car at $35,000 or at the lowest price, right? So there's still plenty of demand for Tesla. And, like I mentioned earlier, it's a brand that has so much power. It's almost like a lifestyle thing with Google or Apple. So as long as consumers are still interested, they're going to do well.
Tesla trading at new session highs and after hours trading up 14%. Dana, this is after a very tumultuous quarter. Elon Musk's run-in with the SEC after he claimed that he was planning to take Tesla private and had the funding secured for it. Tesla and Musk have now been fined collectively $40 million. He is stepping down as chairman. What are the outstanding issues with this settlement? A judge has approved it, but we're still waiting to see who will become Tesla chair, correct?
We're still waiting to see who the new chair will be. We should know that by mid-November. And then the board has to appoint 2 new independent directors by the end of December. And we don't know who those folks will be either. The board has been really mum about the search process. It's not clear if they're leading it internally, if they've contracted with a search firm, but that's going to really change the dynamics of the board.
Meantime, they're supposed to be also monitoring his tweets and his communications, correct?
That obviously hasn't kicked in yet.
Well, exactly. The tweets have continued, and Akshay, I'm curious if you remain at all concerned about Elon Musk's other behavior, and if that is something that you're watching.
It is something we're definitely watching, but the reality is I think Tesla has a lot of leeway as a brand when it comes to consumer perceptions, right? It is always under scrutiny, but I think a lot of consumers do see this as, Elon is different. As long as he doesn't do anything egregious, we can take some of that if they're building these beautiful cars, and hopefully the quality comes along with it. So I do think the brand has some leeway as far as that is concerned with consumers.
Dana, do we have any indication of who the chair will be? No, we really don't. I mean, a lot of names are floated out there, but that's kind of just wishful thinking. The chair could be someone existing who's already on the board. It doesn't necessarily have to be someone from the outside.
Akshay, who would you like to see in that role?
There's so much speculation right now. I think one of the important things is that obviously the Model 3 is Tesla's first really go-around with mass producing a vehicle. For a lot of consumers, it's going to be their primary vehicle, not their secondary or tertiary vehicle like the S or the X will be. So I think someone with auto industry experience might be important. We've seen rumors of James Murdoch and some other people. Like Dana said, we have no clue, but it'll be someone with experience and someone with, deep leadership experience. We can probably expect that much.
Dana, we've also seen some analysts who have been very pessimistic about Tesla change their view. Now they are optimistic. Now they are long on the company. But what are the outstanding concerns that you're hearing from investors and analysts?
Well, I think, the concerns have shifted. First, it was, can they produce the car? And that took them a long time. Then it was, can they sell the cars? There's still demand. Now you're going to see the questions around service. Now that they've built and sold these cars, can they service them? If people have issues with their vehicles, can they get them fixed in a timely fashion? And Tesla is still clearly building out the infrastructure around that. And there definitely have been some snafus. You see people on Twitter asking Elon for help with whatever service issue they've got.
And sometimes he responds. So that can be an expert move. Okay, Dana Hall, Bloomberg Tech, thanks so much. Kelly Blue Book's Akshay Anand, thank you as well for joining us. Staying on the earnings front, Tesla is facing rising competition from traditional automakers like Ford and GM. Ford just reported earnings after the bell, posting a beat. Our David Weston caught up with Ford Motor Company CFO Bob Shanks from Dearborn, Michigan. David started by asking about Ford's investment in electronic cars and pointing out that the company is lagging behind GM.
Well, I wouldn't say that we're terribly concerned about where we are versus others. We feel very comfortable about the progress we're making on the technology itself. We actually are also in the process of testing our business models in Miami, and we just announced we're going to take that into Washington, D.C. So I think we feel comfortable that we're on track to launch a commercially viable business around AVs, moving people and goods in 2021, which is the timeline that we've had for quite some time. So I think the progress that we're making is pretty much what we had expected, and we're excited about it.
And can you do that on your own, or do you need partners? You have some competitors who are taking on partners. I know you've restructured your business so that you can at least theoretically bring investment in. Where are you in that process?
Yeah, we've set up what we call AV LLC as an entity where we could potentially partner with others in this effort, and we're certainly open to that. And since we made the announcement of that, we have received interest from a number of different parties. So nothing to announce today, but certainly that is an opportunity and something that we're open to.
David Weston there, speaking with Ford Motor Company CFO Bob Shanks. I want to bring in our Detroit Bureau Chief, David Welch, for more on the growing competition in the EV market. So, David, put Ford and GM into context with Tesla and, of course, the latest numbers that we've just seen.
Sure. So Ford, Bob Shanks may be comfortable with this, but their profits went down to 29 cents a share from 44 cents a share a year ago. They did beat estimates. They also beat on revenue, but if you start to dig in, it doesn't look so great. They beat revenue because people are buying more expensive trucks, not because they're gaining market share in any place. They lost money again in Europe. And very importantly, I know the shares are up after market. I wonder if there will be give back tomorrow because CEO Jim Hackett has pulled back on their margin targets for 2020, and that's not a good sign looking forward for the total business. So they've got challenges ahead. GM will see their numbers coming out later next week. they've had issues with sales being down in China and down in the U.S. in the quarter. GM's still making good money, but with sales being down, there's going to be some pressure there. And then on the other side, you've got Tesla. First really big profit here, and it looks sustainable. They made a lot of money. They generated $881 million in free cash flow, which is a big number for them. And Elon Musk, the CEO, says they can do it again next quarter because the Model 3 is up to fast production at a good clip and has a lot of buyers. So things looking up for Tesla, things looking a little rough in Detroit.
Tesla and Elon running a victory lap right now. That said, when you look out into the future of this market, there has been skepticism that Tesla, which was not, a car maker first like these auto manufacturers or a traditional auto manufacturer, would not be able to keep up, and that some of these more traditional automakers would eventually catch up in electric cars. Does that look plausible, or is Tesla just, too far ahead?
Well, Tesla does have a really big lead here. They're going to sell something like 340,000 electric cars when you add in the Model S and the Model X. That's a lot of vehicles. The German car makers are just starting to get these electric cars out in real numbers, and those are the vehicles that would compete with Tesla first. General Motors has a bunch of them coming, but you're talking about 2023 when they'll have a whole raft of 20 of those vehicles out in the market, actually global markets. So everyone's catching up, or at least they're engineering vehicles to catch up, but they're a few years away. So Tesla's got a lot of runway here to get ahead of everybody and really establish that Tesla brand as synonymous with EV to buyers in the U.S. already, and now they're going to go to Europe and China next year. So they've got a big brand and a big market advantage getting the technology on the road.
Right. Andrew Left of Citron Research, a vocal Tesla critic, now turned optimist, saying that Tesla is taking customers from Mercedes and BMW. Okay, David Welch for us in Detroit. David, as always, thanks for stopping by. Coming up, looking to the cloud. How Microsoft is riding its cloud-based services to a record first quarter revenue. That is next. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Microsoft's first quarter numbers are in, and it looks like its cloud business is still driving growth. Profit and sales for the period exceeded analyst estimates. Revenue was up 19% to $29 billion, and revenue from Microsoft's Azure cloud services jumped 76% as the company works to fulfill CEO Satya Nadella's vision of transforming the once Windows-dependent company into a service and cloud-centered business. To break it all down, let's head to New York, where Bloomberg Intelligence's senior analyst, Anurag Rana, is standing by. Anurag, thanks so much for joining us. So first of all, I want to ask you about these cloud numbers. Obviously, growth continues to soar, but not quite so fast as in the prior quarter. Can Microsoft keep this up?
Yeah, absolutely. I mean, 76% in constant currency is still, about 2.5 times bigger than more than the overall cloud market. So that's very strong, frankly. Overall, total revenues of about 18% in constant currency is, I think, one of the strongest numbers I have seen, as far as I can remember. To put in context, the entire software industry is growing at about 7%, and Microsoft is growing at 18%. I mean, that's a very big delta.
Office 365 sales also jumping 36%. It certainly seems like, Satya Nadella's turnaround and transformation of this company is working. What could undermine that? What are the headwinds ahead?
I think the headwind could be, macro weaknesses across the world next year, where the comparison become, really tough for them. Apart from that, I don't see any structural problem because Microsoft is now the de facto leader in hybrid cloud. Their on-premise products are doing well. Their cloud products are doing well. The investments that they made over the last several years are now paying off, both in terms of revenue growth as well as margin expansion. So, from other than any macro headwinds, I don't see any structural problems here.
Now, there's a big Pentagon cloud contract that Microsoft is competing for along with Amazon and other cloud competitors. It's a controversial contract. Both Microsoft CEO Satya Nadella and Amazon CEO Jeff Bezos has said, look, we believe that the government deserves to be defended, essentially, in response to concerns about both companies working with the government. How big a deal would it be if if Microsoft won that contract over Amazon?
I think it will be a very big deal. It will be a signature statement because, a few years ago, Amazon beat Microsoft for a similar contract with the CIA. And if Microsoft is able to edge Amazon, it's going to basically announce that their cloud products are as good, if not better, than Amazon. And I think that's going to make a very big statement.
Google is on both of their heels. How significant a threat is Google at this point?
See, Google is very good when you're looking at a cloud-native company or somebody that's a startup. But enterprises that have bulk of the IT spending still, Google is still trying to get a good foothold in that, which is what we call the hybrid cloud strategy. For Amazon, they have partnered with VMware. Microsoft has their leg in both the legacy world and the new world. For Google, it has to figure out a way to be a partner with somebody where they can take some of the older stuff and move it to their cloud.
All right, Anurag Raga, Bloomberg Intelligence. Anurag, thanks for stopping by. Coming up, Apple CEO Tim Cook takes on Google and Facebook in the latest round of Silicon Valley smack talk. We will tell you what was said next. And Bloomberg Technology, live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.
We shouldn't sugarcoat the consequences. This is surveillance. And these stockpiles of personal data serve only to enrich the companies that collect them. This should make us very uncomfortable.
Tim Cook, once again, taking shots at Apple's competitors. Apple CEO made those comments at an EU privacy conference in Brussels on Wednesday. Cook has made this point before, reminding people that Apple's business model depends on you buying their products, not them reselling or using your personal data. It also comes a month after the news that at least 30 million Facebook users' data was exposed in a breach, and after a Bloomberg report stating that Apple was the victim of a Chinese supply-side hack, a report that we should note Apple has vehemently disputed. To discuss this latest war of words, we've got Bloomberg Tech's Mark Gurman in LA. So, Mark, what do you make of Tim Cook continuing to push on this in the face of opposition from other companies?
Yeah, Cook has really made privacy his perhaps #1 priority as CEO, at least in terms of what he talks about all the time. You can't go to an Apple product launch, what they call a keynote, without them harping on the privacy of whatever product they had just introduced. They've always had slides at the end of each product introduction to talk about how their products are responsible in terms of the environment. Now they have the same thing going in terms of privacy, and it feels like he either has a new privacy-related speech or a new privacy-related piece of software or hardware at every launch.
Now, Mark Zuckerberg has hit back before. Take a listen to what he said via video at this conference in Brussels.
We've reduced the ways that advertisers can target ads, and we're building a new tool so people can clear their history of all the browsing activity off Facebook. We're investing heavily in both privacy and security. We now have more than 20,000 people working to keep people safe and protect their information, and we recently created a new privacy and data use team with the sole focus of giving people more control over their data.
Facebook and Zuckerberg have made the point that they couldn't deliver Facebook for free if they didn't charge advertisers. Google also hitting back the statement from Kent Walker saying that Google can deliver search to people of all income levels everywhere in the world for free. And as we know, Mark, Apple products are fairly expensive. Is it a little hypocritical for Tim Cook to be taking this line, or does he have a point?
It's not exactly hypocritical. It's more of a marketing element, right? What they're saying is we're not going to release free products. We're going to release really expensive products that integrate all these privacy features. So it's something they've really been harping on, and they've really made it core to the company in recent years, more so than in any time in the company's history before.
Tim Berners-Lee weighed in on this. This is the so-called creator of the internet. Take a listen to what he had to say. We don't have that quote from Tim Berners-Lee, but he talks about how actually users do have the power right now to be part of this conversation. And my question mark is, do users actually care? How much do users really care about their privacy, given how willing they have been to hand over their data to Google and Facebook over the last several years?
I think there's a large contingent of users who really do care about their privacy. They want to know that their text messages, their emails, their calendar appointments, all that stuff you store on your phone is encrypted. But I think the bigger question being raised here, does the functionality of these products take a hit because they are developed with privacy in mind? And if you look at this sort of war between Siri, Apple's voice assistant, and Amazon Alexa and Google Assistant, Siri is widely considered to be subpar compared to the competition. And one of the driving forces behind that is that a lot of the techniques that Apple uses are on-device processing, which is not as powerful and sometimes not as accurate in terms of voice recognition as storing everything in the cloud. So there really has to be a point where Apple's able to get its devices to be as private as they want them, but also as good in terms of functionality as the competition. Apple says they're already there, but I know a lot of people don't agree with that.
And quick, we are expecting another Apple event next week. What are you watching for?
Right, so October 30th in Brooklyn, they will be launching new Macs as well as the biggest update to the iPad Pro since it launched 3 years ago.
All right, Mark Gurman for us in LA, who covers Apple. As always, thank you, Mark, for joining us.
Thanks.
Coming up, Tesla shares soaring in late trading as the company reports its first money-making quarter in years. We'll talk to a Tesla shareholder and hear what he has to say about the, quote, historic quarter next. Plus, it's bad news for the semiconductor industry, how U.S. and China trade tensions may be hurting chip makers globally. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Elon Musk is calling this a historic quarter, and he's not wrong. Tesla not only made a profit, $312 million, and the company generated $881 million in free cash flow. This company has been a quarterly cash burner, and even though Musk promised a good quarter, it was tough to believe him, as Tesla routinely misses production targets. But this looks real. Tesla made an average of 4,300 Model 3s a week, with 455,000 people having expressed interest in the car. He can keep selling on that production. That's big revenue and real profits. In about an hour, Musk will take the floor on an earnings call to discuss more. From LA, we've got Gerber Kawasaki CEO Ross Gerber. Gerber's company owns shares of Tesla. And joining from London, Swing Technologies co-founder Tommy Stadlin. Tommy, also a tech investor and entrepreneur. Ross, I want to start with you. As an investor, you must be pretty pleased. What's your biggest takeaway from this report?
It's even better than I expected. I mean, we modeled out certain numbers ourselves, and he even beat those. And I'm really the only guy on Wall Street, or I'm not on Wall Street, but I'm the only guy in this industry that actually believed in Elon's numbers. So, I'm really pleased to see that the actual margins they've been shooting for are there in the car. And granted, they sold the higher end models this quarter, but this was much more profitable than we expected.
Let's say you were one of a few. Tommy, what about you? When it comes to the broader EV landscape and investing there. Is Tesla really, creating a tough hill to climb for everybody else?
I think they are. I think they're really beginning to build that defensive moat, which a lot of people were looking to and wondering, were they going to be have first mover disadvantage to some extent, or where they would create the demand for electric vehicles, show that it's feasible, and then the big guys would come in and sweep it all up. And actually, I think what we're seeing here is Elon Musk making good on his promises to generate profitability in Q3 and Q4. And I think it's a historic day. I think Tesla are absolutely right when they say that. For the Model 3 to be the best-selling car in America by revenue, I think is actually pretty historic. And it goes to show that Tesla can make good on their promises and can play by the Wall Street rules. We've seen a lot of issues there with the CEO, Elon Musk, winding up short sellers and having his run-in with the SEC. But this was a good day for Musk and for Tesla.
So, Ross, I'm curious just how bullish you are. How much better do you think the Tesla story can get?
Well, this is just the beginning of what will be a historic run for the company over the next 5 years. I mean, this story can grow exponentially as they now accelerate their production plans in China. And China is really, really all in on the EV business. And being the only 100% owned U.S. company factory in Shanghai is a huge, huge opportunity for Tesla to make a fortune in one of the best EV markets. It is the best EV market in the world. So we see this consecutive launch of the Model Y, the truck, hopefully the Roadster soon, just continuing to ramp up their growth and a level of growth that we haven't seen really from any tech company recently, but especially any car company.
That said, Tommy, you've got other car makers on Tesla's heels. You've got the question of whether Tesla can continue to service all of these cars now that they are all out there in the wild. Can Tesla keep it up?
I think it's a great question, Emily. They have obviously a very different model, different distribution model, a lot of online sales, a lot of owned dealerships and so on. They're doing things in a very, very different way. They really are disrupting the auto industry. And I think you raised a good point. How do they deal with these cars in the wild? We haven't seen large volumes of Teslas out in the wild year upon year upon year. So that will be an interesting challenge. But look, so far they keep on meeting those challenges head on. I think what I would like to see, if I were an investor, which I'm not in Tesla, I would like to see just that executive bench of leadership be built out a little bit. Obviously, they're going to see a new chairman come in, or chairwoman, which is enforced upon them. But they've also had some departures at the executive level, which you probably want to see that bench deepen there, just to bring in the experience to deal with the types of issues that you're talking about.
Several departures, in the finance department, in the manufacturing department. Ross, how much of that is a concern to you?
Well, it's obviously a concern, but when you look at it in the context of the just enormous stress that the company's been under this year, it's not surprising. Just the stress I've been under as an investor, I can't imagine working there. So that doesn't surprise me, although it's not preferable. But I agree that the most important thing that they do is build confidence by building up a management team around Elon. This is the opportunity for the board and the company to make very strong steps to build a plan to be a much bigger company. We can't have a company where only one guy is the main factor in the company. Succession planning is hugely important. So I agree. I think that's the next big step for Tesla, is to continue to mature as a company.
Well, and it seems that Elon Musk has been able to do that at his other company, SpaceX, but he hasn't been able to do that over and over again at Tesla, Tommy. Musk, even though he's apologized for certain things, it doesn't seem as if his behavior is really changing. So can we be confident that will happen?
I don't know you could ever be confident that Elon Musk will conform. I think he's the ultimate non-conformist, and he's taken a lot of criticism for that. Much of it obviously self-inflicted with his rather impulsive tweets. And you'd like to think that he is intelligent enough to stop that kind of behavior. But I think he has taken a lot of criticism. And today is, I think, to some level, vindication for him. This is a guy who has almost single-handedly dragged forward electric vehicles and made it aspirational, and then single-handedly dragged the rest of the auto industry with him to say, okay, we are moving to an electric vehicle world. And that is huge news for Tesla. It's frankly huge news for society as well. I think often as onlookers, we can get a bit down on business, and there's certainly been lots of bad news in terms of the relationship between business and society recently, particularly in tech. And here I think you see someone who is genuinely making the world a better place. He is nonconformist, but I think shareholders who invested and bought the stock, they knew what they were getting in for. They were getting themselves into a company which had a CEO who was a visionary, who could drag things forward, who could really disrupt industries, but who was never going to be a sort of career CEO who always played by the rules. Now look, he has to play by the legal rules, and he fell foul of that, but I think he's learning on the job. And yes, he has to learn how to move from a sort of ultra growth phase, an ultra disruptor phase, if you will, and learn how to really scale that into the mature company that Tesla can and should become.
Right, and Elon Musk certainly deserves credit for all of that, but let's take a look at some of the other things that happened this quarter, one of which was promising that he was going to take Tesla private and had the funding secured to do so, which was in fact not true. Both Tesla and Musk had to pay, $20 million fine because of that. He has smoked weed in a video podcast. He has cut off analysts, been outright disrespectful to analysts on earnings calls. So Ross, as much as you like Elon Musk, what would you like to see less of?
Emily, I think all of your criticism's fair, but when you look at CEOs like Les Moonves being removed from office for attacking people in his office or whatever you might say, this is benign stuff compared to some of the stuff you're seeing in CEO offices all around major corporations in America. So let's keep in perspective smoking pot versus sexual harassment, for example. And so I think, I don't personally think Elon is normal or should be try to act normal when he's not. I think the tweet was a mistake, and it certainly was a costly mistake, but far from the worst thing a human could do. So I think it's a hypersensitive environment around Tesla. A lot of Elon's fans actually like that he's a real person and a human being, and looks like, a pretty interesting and fun guy too. So, I think some of that criticism is reasonable and fair, but we live in a different world today. When you look at the President of the United States and how he acts, and that's the President of our nation, Elon's behavior looks actually quite normal.
Well, to be clear, we're not comparing his behavior to any of the people you just mentioned. I'm asking about defrauding investors or potentially defrauding investors.
I don't think he was defrauding investors. I think he had a deal with Saudi Arabia. The SEC documents clearly say that he perceived that he had a deal with it. The fact he tweeted those two fateful words, even the tweet itself said considering taking Tesla private. If he didn't tweet funding secured, we wouldn't have been there. Look, it was a mistake, and I'm not trying to minimize that, but this is, once again, as far from the type of corporate scandals we see at Facebook, for example. It's nothing.
Right. And from the Saudi side, it certainly seemed not clear that there was ever a deal in place.
But they're buying everything. The Saudis are buying everything they can, and now we know why.
Well, they've been trying to. We'll see what happens next.
Yeah.
Ross Gerber,
so
Gerber
I believe
Kawasaki.
this is legit.
Thank you. Appreciate you sharing your views here, as well as Tommy Stadlin, Swing Technologies. Thank you both so much for joining us. I'm sure Elon will give us plenty to talk about in the weeks and months to come. Coming up, a sell-off in U.S. stocks. Wednesday, we saw the Nasdaq post its worst day since 2011. Disappointing earnings from AT&T and Texas Instruments drove the declines. We'll break it all down next. This is Bloomberg. The Nasdaq took a plunge into correction territory Wednesday as a sell-off in semiconductor and FANG stocks continued to rattle the market. The tech-heavy index dropped more than 10% following several disappointing earnings, including Texas Instruments. The semiconductor company missed analyst estimates, posting $4.26 billion in revenue, while also issuing weak fourth quarter outlook. The forecast is bad news for investors who've already seen the Philadelphia Semiconductor Index fall 10% this month, and as tensions between U.S. and China trade continue to escalate, the company is warning of slowing chip demand. Here to discuss, Bloomberg TV's markets editor and co-host of Bloomberg Markets, What'd You Miss? Romain Bostic. And on the phone, we've got Stifel Managing Director and Senior Chip Analyst Tore Svanberg. So, Romain, I'll start with you. What is behind the chip sell-off?
Well, I mean, a lot of it's about economic slowdown. I mean, look, there's been a lot of analysts out there that have said that we're sort of at the end of a cycle, and this is a cyclical sector. And I think what you're hearing from companies, not only Texas Instruments, but you look at MKS Instruments, you look at a lot of the European chip makers as well, and you're just not seeing the kind of read-through into the economic conditions, whether it's building for computers or for smartphones or for cars or all the other items that are out there. We're just not seeing the read-through in terms of orders. So you're seeing an inventory buildup for some of these companies. You're seeing pricing pressures for some of these companies. And as they're giving forecasts for 2019 and beyond, they're really not giving investors anything to hang their head on.
So, Tore, do you see this as a sustained problem? Is this the new normal?
Well, it's a very good question, and if you look at the semiconductor industry, it's been very resilient over the last few years. And in fact, we're coming off 6 consecutive years of growth. If you look historically at the industry, I think the longest growth we've seen sustainably has been 7 years. So from that perspective, it's probably not a big surprise that we are starting to now see the reversal of the growth. But I think that the big topic here, of course, is really the actual tariff situation between the U.S. and China. And I think that's anyone's guess how that's going to progress going forward.
Romain, walk us through what these valuations in particular are telling you in the context of what we're seeing in the broader tech market, which isn't great.
Well, yeah, when you look at the broader tech market, I mean, you're talking about a sector that was essentially overvalued, and it was very overcrowded trade as well. And when you start to look forward, again, looking forward at what the future earnings are going to be, what their revenue growth is going to be, and what their pricing power is going to be, for a lot of these companies, the outlook isn't as good. Look, we're still expecting 19% growth for EPS for the tech sector as a whole. That's good. That's high on a historical basis, but it's actually lower than what you're going to get out of the broader S&P. This is the first quarter during this bull market where the tech sector is going to have earnings growth that lags the broader market. And these are also the stocks, of course, that have had the highest valuations over the past 8 years. So at some point you have to say, okay, let's revalue this and let's take a look. You have a NASDAQ 100 now that's trading at 24 times price to earnings. Even when you look at price to sales to take in better account of the nature of these companies, it's still about 3.4 times sales on an annual basis, well above the S&P 500. And you have to ask yourself as an investor, do you want to pay that?
So, Tore, this is a space that has seen, tremendous M&A over the last several years, and then more recently a lot of failed M&A when you look at Broadcom, Qualcomm, NXP. Do you expect the current state to put a chill on deals going forward?
Yeah, I mean, M&A has been pretty tremendous in the space the last 5 years. But, we've been saying since the beginning of the year that, that kind of M&A party is ending. And there's 2 reasons why. First of all, obviously, on the political front and certainly when it comes to regulatory issues, it's been very, very challenging to get M&A to go through, whether that's in China or the U.S. The other part of it, of course, is purely financial. So as, interest rates start to go up, cost of capital obviously is on the rise. And, once that happens, it's just going to be more and more difficult for companies to make the math work, especially for the actual acquirer of another asset.
All right, Stifel Nicholas's Tore Svanberg, thanks so much, along with Bloomberg's Romain Bostic. Of course, we'll continue to watch the chip market as it stands. Coming up, it has been almost a year since online personal styling company Stitch Fix hit the public market. As Amazon moves into apparel, can Stitch Fix stay the course? Our sit down with the CEO next. This is Bloomberg. Welcome back to Bloomberg Tech. We've got some quick breaking news now that on the subject we were talking about earlier, Broadcom said to face EU antitrust scrutiny over its dominance. This coming from Bloomberg sources. The EU inquiry will be focusing on chips in set-top boxes. We're going to continue to follow this story, but as we have reported, Broadcom had attempted to buy Qualcomm in what would have been one of the biggest tech takeovers in history. The White House stood in the way of that. We will continue to monitor this inquiry into Broadcom coming from the EU. Well, in the age of Amazon, retailers are increasingly turning to AI and data to compete. And when it comes to apparel, Stitch Fix is proving to be an algorithm success story. The online personal styling service uses a unique combination of user data and human stylist expertise to dress its customers. Since its trading debut 1 year ago, Stitch Fix users have grown 25% to 2.7 million. And while many online retailers using AI feel threatened by Amazon's looming presence, Stitch Fix CEO Katrina Lake says it's the business of personalization that sets them apart. I sat down with Lake on the latest edition of Bloomberg Studio 1.0. Take a listen.
It's a very different ballgame in apparel. Amazon is amazing if you want to get something cheap and fast delivered to your home. The reality is in apparel, there's much more nuance. Having millions of pairs of jeans to choose from isn't actually that helpful if what all you're looking for is jeans that are going to fit your body well. We absolutely keep an eye, but at the same time, I think we feel a lot of confidence and strength in our capabilities and our focus on the discovery element, and that, you know, that's a little bit of a different business, I think, than what we're seeing most e-commerce in today.
Would you ever sell to an Amazon? Would you ever sell to a larger retail giant?
I think it's clear we've chosen an independent path. So, as we've thought about what are all of the outcomes that are potentially available to us, we have a deep belief and still do that this is a company that deserves to be an independent, publicly traded company, and there's still tons of market opportunity ahead. And so we're very focused on the independent path.
There are a lot of other companies trying to do what you do, other subscription services, whether it is Daily Look, Alume, Gwenny B.
First and foremost, what differentiates our business is it's not kind of the subscription tag. I mean, the business is one that you can do monthly. You can also do it a la carte, and quite frankly, people are not paying the same amount every month as you would in a normal subscription business. The way we look at it is we're in the business of personalization. We do one-to-one, human-to-human personalization scalably.
How real is the data and AI platform at Stitch Fix? How valuable is it?
It is so real and incredibly valuable. So there are a lot of buzzy terms around big data. What we're doing is actually high signal data that people are actively sharing with us that pertains exactly to the experience that they're having. And so people will try 5 things on. They'll let us know, these were too big, these are too small, this was too expensive, I love this, but I already have it, I love it in a different color. These are just the things that people naturally are sharing with us to help us to understand what they're liking and not liking about the product. So 100% of the time, because of the data that we have, we know who buys what. So we know a 25-year-old woman in Louisiana bought these jeans. 85% of the time, we actually know why. And so she's letting us know these are too expensive, this is too cheap, I love this, I love the way this fit on my body. And that, both the breadth and the kind of like depth of that data is incredibly valuable.
So if you have all this data, do you need all those stylists ultimately, or do those stylists go away?
So no, the stylists serve a very important part. And so what that data allows us to do is it allows us to be able to have a predictive ability on clothes and people and what's going to happen. And so we are very able to highly, highly accurately predict this has a 72% chance of working, this has a 38% chance of working, and that data is presented to the stylist. So the stylist is part of the selection process and also part of the relationship building of explaining to you why she chose things and really building that relationship in a one-to-one human way.
In 2017, Stitch Fix went public at a $1.5 billion valuation. You're also the youngest female founder to take a company public. How did that feel?
The whole public offering process was rocky for us as a company. It wasn't kind of, as smooth as you might want it to be in a perfect world. But at the end of the day, I think it didn't really matter. And I think this is a company that's been underestimated before, and we're happy to prove ourselves in the public market. And that day of being able to kind of celebrate and remember the journey that we were on was it was an incredible day. And it was an incredible day to be able to share with all of our clients and our employees and our investors and the people who have had such meaningful impact on how we got to where we are. But it definitely was, it was a day I'll never forget.
What's it like on the other side, post-IPO? Is it easier? Is it harder?
It's different. And I mean, I think about in my job, in the 7 years that I've been doing this, every year I think of myself as rehiring myself in a new job and committing to that new job. It's every year has been so different than the years past. There were years when my job was literally like making sure that everybody's in line getting fixes out the door so that our fixes would arrive to clients on time. And like that was the most important thing that I was doing in 2012.
So what's your job this year?
I now have not just our private market investors, but also public market investors that we're building trust with and that we're spending time with and earning the trust of. You know, there's some small things that change, but I think the heart and soul of the company hasn't changed. And in the ways that it's different, I think it's made us better. I think we look at our financials with more rigor than we did before. I think at the end of the day, like we are focused on making sure that we build lots of long-term value for our shareholders, which includes our new shareholders. It also includes employees, and I think we feel a lot of responsibility for that.
Stitch Fix CEO Katrina Lake. You can catch the full episode tonight, Bloomberg Studio 1.0, at 9:30 p.m. Eastern Time, 6:30 p.m. Pacific. And just to recap, a busy earnings day. Microsoft turned in brisk revenue this quarter as it continues to expand in the cloud. Speaking of strong quarters, Tesla had what Elon Musk called a historic one, in which the EV car maker not only made a $312 million profit, but finally stopped burning cash. We'll continue to cover the headlines right here on Bloomberg Television. That does it for me today. This is Bloomberg.